This is the Daily Market Rundown live from the Tradelo trading floor. It is January the 30th and some highlights from today's show. Meta and Microsoft hold firm on Capex expenditure. Gap trade in the S&P is now in play and the ECB comes into focus. Welcome traders, it's another market rundown. Let's get stuck straight into it. Some of the overnight market moves, of course, European equity markets continue the slow grind into record high territory, led of course by the DAX. What's going on in Europe? Why is the European stock markets sort of rallying and leading at this point? Well, there's a number of reasons. Perhaps Europe is cheap relative to everywhere else in the world. It's obviously seen significant underperformance for a number of years. So perhaps it's cheap. That's one side of the coin. The other side of the coin is, of course, the ECB is cutting far more aggressively and providing more stimulus than perhaps what the Fed is. That's another side of the coin. And yeah, I mean, don't forget, of course, the equity markets are not economies. That's something you learn very quickly as a trader. You know, back in the day, perhaps 30, 40 years ago, before we had so much central bank intervention, the stock markets were far more closely linked ultimately to the economy, and when the economy did poorly, stock market performance did poorly. That's not the case anymore. The DAX in particular is very much led by just a handful, 4 or 5 different stocks pretty much that are driving those gains. So don't look too much into it. I think if you're trading the DAX, the price action is very clear. With that in mind, of course, we did have a number of GDPs come out this morning from Europe, and they really do look bad. And it does confirm this sort of stance that the ECB is going to need to get on with these rate cuts and perhaps turn a little bit more dovish today at today's meeting. But we'll discuss that in a moment. Now, let's turn our attention and come to our first topic for today. And that's very much just a summary of Powell. I posted this for you in the central bank channel. You can go and review this. There's a number of other posts. But just to summarize Powell, what did he say? The short answer is there was a slight adjustment to the statement that the market took as somewhat marginally hawkish. It was the sort of referencing inflation as perhaps not being on track, or perhaps not having as much confidence that inflation was on track. So there was an initial hawkish move when the statement dropped, but a half an hour later Powell was prompted or queried again on this removal or adjustment to the statement, to which he said, don't look too much into it. It was just an adjustment from a text standpoint. So he kind of watered it down, and the result was pretty much yesterday there was no real change. I think fundamentally we learned pretty much absolutely nothing from the Fed. But yeah, as a key summary from the Q&A, I think there's a few things to point out. Like I said, don't read too much into the adjustment of the statement. That was one of the key things we learned from the Q&A. A March cut is not likely, okay, because the Fed doesn't seem to think they need to be in a rush because they have policy very well calibrated. They then also spoke about the 5-year review coming up, and they explicitly stated they will not be adjusting the 2% inflation target. Powell told us that policy is still meaningfully restrictive and neutral is still meaningfully lower. And I think this is an important line now. This is something you kind of want to put a sort of an exclamation mark against, because if he still thinks they are meaningfully restrictive, he believes that there is rates are sufficiently high enough still to be sort of removing demand from the equation, and that's what he believes is going to bring that inflation rate back down to 2% next year. Okay. As well as he still believes neutral is meaningfully lower. What he's telling us in essence is there's still a number of rate cuts to come before they reach that R-star or that neutral run rate. Okay. So what that tells us, there's still a number of rate cuts coming in. We don't actually know what meaningful means. At some point, perhaps he would be queried on this. Jerome Powell, what do you mean by meaningful? Is it 1 cut, 2 cut, 3 cuts? But we don't know what that means. The point is that the word meaningful is one you want to put in your memory, because at some point he may adjust that word meaningful, and that will then be taken either as hawkishly or as dovishly. Keep that in mind. And then, of course, he told us long rates are going up due to term premium. I think this was interesting. What he was kind of leaning on is this idea that the Fed is not the reason that rates at the back end are driving higher, but in actual fact, it's due to term premium. And then finally, we still have abundant reserves. In other words, they're still going to continue along the path of quantitative tightening. So a number of different elements there. The net result, nothing really to take from it. There was no policy adjustment. The markets weren't expecting a rate cut in March. Of course, it's still possible. The Fed remains data data dependent, but the reality is March is now not likely, and it's very much looking like a June slash December rate cuts from the Fed. Okay. Now, turning our attention to the second part of the night, it was all about earnings. This was the big event of the night. It was about what does Meta and what does Microsoft tell us about the DeepSeek and Alibaba story. Well, the short answer is, unfortunately, they told us nothing. Unfortunately, they just seem to kick the can down the road. And I think this is how you have to look at it, okay? The AI story or the AI narrative is definitely not dead. No way, Jose. Okay, you cannot tell me that Chinese models providing a product at a subscription fee that's 1/30 of the price of US models is not going to have a long-term impact on earnings for US companies. It is. We just don't know what that impact is yet. And I think both the Meta, both Zuckerberg, of course, and Microsoft did a very good job to steer very far away from trying to give too much understanding as to what the implications are going to be, for obvious reasons. Okay, they're talking to their investors. The last thing they want to do is get their investors bailing on the stock and seeing their stock price down 10% overnight. So the two key takeaways, I think, first of all, was Meta. Zuck was asked about the whole DeepSeek story, and he kind of came back and said, look, investing in heavy capex is very, very important from a strategic perspective. And what he's leaning on this idea is that, sure, DeepSeek's done a very good job and they'll learn a lot from it. But in reality, they focused on more on the future, which is when we do get inference, when we do get, sort of demand soaring from consumers, we are going to need to have that capex in place to be able to take advantage of that demand. And I think that's how they're leaning on it. That's how they're looking at it. It's very much strategic in them spending the 60 to 65 billion capex this year. Unfortunately, he didn't answer the other side of the question, which is, well, are you actually going to generate a return on that capex? Now, it begs to be seen. I think he did go on to say, I'm just going to fast forward that to the next slide. He did go on to say that, ultimately DeepSeek has strengthened our conviction in the importance of the investments, indicating that the company does not anticipate immediate reductions. But he did tell us ultimately that at the end of the day, it still has to be seen what the implications are. Okay, he really did lean into that idea that they will be nimble, they will be investigating it to make sure that they're not just lavishly spending on capex. Okay, if we look at what Nadella from the CEO of Microsoft told us, she said, well, look, the spending was needed to overcome the capacity constraints. In other words, similar kind of thing, which is there is a constraint on available capacity right now, and we need to provide that. Hence, the 80 billion from Microsoft stands good for this year. Okay, but like I said yesterday in yesterday's rundown, it's not about this year's capex. This year's capex has to be rolled out. You don't start building a factory and stop halfway. It doesn't work that way. So it's very much about next year's capex. And so why I leaned into this idea of it's about kicking the can down the road, because I think what we're going to find out over the course of this year, perhaps in the Q2 earnings, is we're going to find out that they're going to give us some sort of guidance that perhaps earnings might be lower, or perhaps they may actually need to spend a little bit less on capex next year, because then they would have had quite a bit of time to investigate, what Alibaba's doing, what DeepSeek's doing, and fully understand the landscape a lot better. Okay, that's the takeaway from it. That's all you need to know about it. But the markets liked it in general, and what I mean by that is we are very much staring today at gap rules. What you can see there is Meta is up marginally overnight. I think they're up 1.5 at the moment. We can see Microsoft down 4. Just a little bit of a guide on their AI spending, in particular with Azure, was a little bit weaker than expected, but not too much to take away from that. I think the key for today, of course, is going to be the VIX and Nvidia. What we can see right now is Nvidia still holds below that 127.29, and I think so long as we stay below there, you've got to be on high alert for some sort of either more rotation out of tech into value, or alternatively some sort of a risk-off type scenario where we continue in this lower range, in particular the NASDAQ and the S&P. Okay, now VIX is going to be the key. Okay, I'll talk in a moment about the gap play, but VIX is going to be the key to all of this. 16.5 is pretty much where we opened Sunday night, so keep a close eye on that. If we trade below that today, I suspect S&P goes and fills that gap, so does the NASDAQ. Where does that gap come in? Well, let's talk about that briefly. What is the gap rule? I'm going to annotate it for you. I'm going to draw it for you. If this is the gap, so you can see here we have a gap, and effectively S&P, NASDAQ both sold off. Okay, we're now currently sitting in and around that gap. We're hovering very close to sort of where we opened on Sunday night. Now, what gap rules tell us ultimately is that once we start to come back inside that gap, we should effectively trade to the other side of the gap. Now it's going to fill out, tag the gap close, and then most importantly, a lot of two-way distribution, okay, as the market accepts that gap as now closed. Now, very, very important, and this is important to understand about different types of gaps. You get fundamental gaps, which is what we saw on the weekend, and it's important to understand that that fundamental gap drove a lot of selling. Now, when I say selling, I don't mean fresh short positions. What I mean is a lot of long liquidation. In other words, the move that we saw Monday was a whole bunch of long positions just liquidating and selling out. Okay, and that's very different to if we had fresh short positions, a whole bunch of people just shorting the market. Okay, because the difference is once we start to fill out that gap, if we had a whole bunch of short positions, you would see the market do some sort of a stop up to the other side. In other words, quite a strong straight line move to the other side. However, because it was a long liquidation move, what I suspect you'll get in terms of today's gap is you'll see a lot of this kind of, slow grindy kind of stuff, and eventually it'll tag that and then eventually rotate a little bit lower. Okay. In other words, the price action inside today's gap is going to be quite tricky. The way to play it, you simply got to be long once we trade above that's 6100 in the S&P, and you got to be trading it up to 6135 and then look to be short around that 6135 and trade it back down towards that 6100. Okay, this is to trade this, you stay out of the price action, you definitely don't want to scalp it, and you very much want to trade point to point. That's the gap rules, and that is how we'll be looking to execute the S&P and Nasdaq today. Now, we've got, there's an example of it. Sorry, there is the actual S&P 500. You can see that chart. You can see we're just sitting in below that 6107s. A few things to point out. If I can get on this chart, there it is there. There's the gap from Sunday. You can see there's the close on Friday, 6135. And you can see we've got, roughly speaking, 30 handles. Or a little bit more now, 40 handles to go and fill that gap. And then, like I said, don't be surprised to see a lot of two-way trade filling out that gap. Okay? However, caveats. Always need caveats. Okay, everything is going to be determined by the VIX and by ultimately what the Mag 7 do. So it's not to say that we have to fill that gap. It is to say that once we start to fill it out, it should fill it out and rotate. Okay, very, very important to stress that. But if that VIX does start to bid up, if we get above, particularly that 17.5 level, if I just go back to that chart of the VIX, if we start to get back up above that 17.5, which was yesterday's high, all bets are off, and we're going to not just test in that 60-60, but we're going to go very quickly back down to that 60-23. Okay? The risk of AI is very much there. It will be there now for the next couple of weeks and months, so you have to be switched on for it. But for today, of course, things seem a little bit calmer, and the gap play seems to be in play. Now let's talk ECB. Of course, it is the ECB. It's the key sort of central bank for today, alongside, of course, US GDP. What do you need to know about the ECB? A number of things. They are expected to cut perhaps at the next 3 upcoming meetings, so Jan, March, April. You can see very much the market's pricing in around 62 basis points over the next three meetings. So quite a dovish outlook from the ECB. They expect it to be dovish as well today. And just a few takeaways from the December meeting. They do see inflation for this year averaging 2.1%, so they back at target in terms of where they want inflation. Hence, they are very happy to continue cutting and getting to neutral as soon as possible. They then go on to say, of course, that they still think the monetary policy remains restrictive, okay, and that the past interest rate hikes are still transmitting outstanding stock of credit. In other words, they still think they've got some way to go to get to neutral. Hence, the market thinks they're going to cut at least 4 times this year. And then, of course, they did also tell us they revised down their growth forecast. And I think this is an interesting one because they're still forecasting 1.1% for 2025. And I think that's where the market's now starting to lean into this idea that the ECB could turn dovish and perhaps even signal perhaps something more than a 25 basis point cut at one of the upcoming meetings. Okay, now that would be very, very unusual because we've seen the ECB reluctant to do this throughout the course of their cutting cycle so far. But one thing to pay very close attention to, we've of course got inflation break-even sitting around 2.05%. Okay, not problematic yet, but perhaps a little bit uncomfortably low for the ECB, particularly because they are cutting rates. Okay, they do want to see those inflation expectations rallying whilst they're cutting, not moving in the opposite direction. So keep an eye on inflation expectations. They drop below 2%. That could well force some commentary outside of today's meeting about perhaps more than a 25 basis point cut incoming. But the key takeaway is, of course, GDP. Okay, another very shocking print today. France comes in with a negative print quarter on quarter with a year-over-year growth of only 0.7. Like I said the other day, you can see Germany comes in with a negative 0.4 on the year-over-year. Just a shocking print for Germany. Very much 2 years of recession in Germany now. And then, of course, Italy. Okay, just a meager 0.5 GDP for the year. So these are the three biggest economies in Europe. Now remember what I told you, the ECB thinks they're going to grow 1.1% this year, and that growth isn't coming from the three biggest economies. Okay, will it be driven by the likes of Spain, who very much was the star outperformer this year? Well, let's see. Okay, when the rest of Europe's in recession, it's not like Spain's going to outperform, because at the end of the day, Spain benefits from the rest of Europe. So this is what's driving people to be a little bit more dovish on the ECB, and perhaps that's what you want to be focusing on today from Lagarde. Now, a very interesting chart and something to pay very close attention to. It's a bit of a rebasing index. So what we've got here in purple is you've got the US 10-year bonds. In pink, you've got UK 10-year bonds. And in green, you've got German bonds. Now, what you should notice, this is all price. What you can see is German 10-year bonds are down 1.1 versus US bonds up 0.5 on the year. Now, this should be a little bit of a head scratcher. Why? Well, because why are German bonds the underperformer when the ECB is the most aggressive at cutting rates? Okay, is it because maybe the ECB's policy is leading to some sort of higher inflation expectations? Well, the short answer is no, because inflation expectations are sitting around 2.02%. So why is it that German bonds are underperforming? Okay, and that's a key question to answer. I think that question is going to be answered in the next couple of days. I think it has to do with the big S word, stagflation. I think we're starting to see some stagflationary fears come through, where economists are saying, well, look, Germany, you're growing 2 years of negative growth. Unfortunately, we're not going to be buying your bonds at such low interest rates. We're going to demand a higher term premium. Okay, so I think we're seeing this sort of term premium idea start to filter into German bonds now. What does that mean? Well, if we do start to see those German bonds start to offer quite hard and aggressively, don't be surprised to see a little bit of a repeat of what we saw when the UK bonds did the same thing earlier this year. Okay, what would that mean for us as traders? Well, it would very much mean that euro is going to parity a lot sooner than expected. Okay. And then finally, our chart on the euro there, you can see it. I've been mentioning this level 104.40. Notice we sprung above it. We spent a little bit of time above it. A little bit of a head fake. We're now back below that resistance. Path of least resistance is back down towards that 102. Okay, all bets are off for the euro. I think ideally today, if the ECB is not as dovish as the market wants, you might get a little pop up to that 104. One last little kiss of death onto the 104.40 might give you that final opportunity to sell it. Get short. That market is looking like it's not just going to stop at around that 102 or halves, but perhaps move its way back down towards the yearly lows. Okay, that's it then for today. If there are any other questions, of course, do post those in the Discord channels. One final note, we have got a US GDP, which will, of course, get quite a bit of attention. Don't forget the US is the growth driver of the world right now, so we would expect to see good prints out of there. Don't forget as well, part of that is we get the PCE reading, which is the quarterly PCE reading. So don't forget, it's not the monthly one, it's the quarterly one. So it's a little bit backdated. It will get some interest, but the key PCE for the Fed is coming out tomorrow, and that will of course be very closely watched, given what we of course just heard from Jerome Powell yesterday. Okay, that's a wrap then for the rest of the day. Good luck out there, manage that risk, and go make some money.